Welcome to SB Talks. Today is Thursday, August 13th. I am Vincent O'Neill and joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now today, Nick and I will be discussing a potential US Goldilocks scenario of moderating CPI and strong corporate earnings. We'll discuss what the inflation picture means for the Fed and the Reserve Bank of Australia and what we are looking for in the current domestic reporting season. Welcome to all our listeners. Let's start on the macro, US CPI and non-farm payrolls specifically.
Yep.
Taking some pressure from Kevin Morris and the Fed.
Yeah, so last night we had the US CPI for July. It was pretty much as expected. So we saw headline inflation tick down from 3.5 to 3.4, and core inflation, which backs out food and energy prices, that slowed from 2.6 to 2.5. So that's actually back to the lowest level it's been in 5 years, 2.5. So, you know, if you make sort of mental adjustments for the differences between CPI and PCE, which is the Fed's preferred measure, then you're probably looking, you know, around a little over 2%.
Do you mind stepping out a little bit, what would be the differences there between CPI and PCE?
There's some differences in weights and what's included in the two measures. I don't have all the details. For example, I think, you know, housing might have a bigger weight in one than the other. So typically CPI runs a little bit higher than PCE inflation.
But it's fair to say a number 2.5 doesn't sound nearly as ugly as what we were looking at maybe not so many months ago.
Yeah, I mean, we have to be a little cautious. There's some things moving around like airfares. There's obviously accommodation, you know, we obviously had some distortions around the World Cup. Fuel prices bouncing around, you know, this probably predates some of the rises in fuel prices. Not that they're necessarily included in core, but they can have the second round effects.
I was going to say they'll seep their way into the system elsewhere without a doubt.
But you know, other measures. So one of the things that the Fed's looked at is what they call super core, which is services excluding shelter, and that's down to 3% over the last year. You know, and that's the lowest in 3 years. So there's some encouraging signs, particularly for those members of the Federal Reserve that were, you know, tending to want to lift rates to be more aggressive in fighting inflation. We had 3 people voting to lift them at the last meeting. So, you know, there's something there for everyone, really.
But I guess to my point, really, expectations are now Fed on hold.
Yeah, so we've seen Fed pricing come in. We now only have a 40% chance of a rate hike at the September meeting and 75% by year end. That's down from about 90 a few days ago. So it's marginal.
But the pressure is gradually lifting.
Yeah.
But again, a close eye still on the data from here.
Yeah. And we also had non-farm payrolls, which you mentioned, that came out last Friday, and that was pretty soft. So non-farm payrolls, we saw 23,000 jobs lost in July and downward revisions of 103,000 to the prior 2 months. So the 3-month moving average is only 20,000 jobs created, which is pretty weak. But given, you know, what's going on in the US labour market with lower participation, so we've had a lot of older workers and prime age workers either give up on looking for jobs or leave the labour market through early retirement. So that's actually pushed the unemployment rate down from 4.2 to 4.1. So if you look at the unemployment rate, you say, oh, well, that's good. But if you look at the total number of people in the workforce, that's actually fallen, particularly for prime age.
I guess it just, as you commented on before, it just shows a broader sort of degree of weakness in the economy that, again, might not be able to sustain significant rate rises.
Exactly. So those two things together, I think, do give the Fed a lot more breathing room to, you know, stay on hold. You know, even though the market was looking for, you know, potential rate rises, given, you know, inflation fears. As I said, some of this is backward looking. You know, we've still got what's going on in the Middle East, and we've got Brent crude up at $89 a barrel, and we've got this new batch of tariffs coming on with the 301 tariffs. So there's still a lot of moving parts.
It feels like those uncertain elements, unfortunately, are just going to remain with us, and we're certainly seeing no significant developments probably worth talking about in the Middle East in terms of this pod. But as it protracts and some of those inflationary pressures do seep themselves potentially elsewhere into the system. So there is, at best, maybe an element of relief that that we're seeing, I guess, a bit of a back off in some of those CPI numbers, such that it can just buy us more time to see what the broader trend is.
Definitely, definitely.
Now, US reporting season, we talked on it on a couple of the recent pods. Now that's behind us. If at a more holistic level, stepping back, fair to say, a pretty strong to very strong result overall.
Yeah, so we have 440 roughly of the 500 companies in the S&P 500 having reported. The numbers show earnings up 51.1% year on year, excluding the energy sector, which is obviously quite volatile, 47.2. Revenue's up 15%, so we had good revenue growth, we had good profit growth, and it was pretty broad-based.
That's a really important question, because when you hear record earnings, record revenue numbers, you just assume, well, this is AI investment, this is data centers.
Yeah, look, no, there definitely is an element of that. So we had both Amazon and Google revalue their stake in Anthropic up. So that did account for quite a lot of the numbers. I mean, Anthropic, I don't know what it's worth, something around $1 trillion, I believe.
And
and that's
not that long ago, it was 300 million on one of the recent capital raises. So
that was a big part. According to Ed Yadani, if you strip that out, you're still looking at sort of high 20% type number. So it's pretty good. But if I go through the sectors, consumer discretionary, that's obviously not Anthropic related. That was very strong. Energy and materials, strong sectors, and then IT and communication services, where more tech related, very strong. So it was more than just AI. It was quite broad based. And
the US corporate sector just remains very resilient.
And profit margins at 15% are a record high. That's the highest they've ever been. So strong profit margins as well. So strong revenue growth, strong profit margins. Some of it's tax, due to tax cuts. Some of it's due to AI. Some of it's due to higher commodity prices. So a whole bunch of things driving it.
But the market has had quite a resurgent run as well. So I guess it's earnings led.
Definitely earnings led. So we've seen multiples actually come down. I think they're around 20 times. They were probably like 22 at the start of the year. So about a 7% improvement in the PE ratio since the start of the year. Yeah.
Excellent. Well, I guess it helps underpin some of the strength of that market and gives, expectations are only raised going forward from here, but we watch on, interested.
Yeah, some people saying it's a bit of a Goldilocks environment where you've got strong corporate earnings, you've got pretty good US GDP growth, partly data center driven. You've got now inflation and interest rates looking more benign. So, tick, tick,
not
tick,
too
tick.
hot, not too cold.
Not too hot, not too cold.
Is that a red flag? There's no such thing as a Goldilocks environment.
I mean, often when the economy is doing as well as it is, you do start to get inflation pressures because it's growing more quickly than supply. Yeah, so it's something to kind of watch out for.
It'll be there in the numbers in the weeks and months to come. Back closer to home, the RBA met this week. Fair to say, nothing particularly new there?
No, on hold as expected. I don't think we learnt too much from the statement that came out afterwards or the press conference. Clearly there was a lot of questions around the property market. Michelle Bullock didn't really say too much about that. It was what was described as a hawkish hold. So they're still saying risk to inflation skewed to the upside, inflation's still too high, capacity pressures remain. So all the sort of things saying, they're vigilant about inflation.
If there is a
risks.
move, it's being no doubt that it would be a move up.
Yeah, and they debated on hold or a hike at the meeting. Obviously, they stayed on hold, but there certainly was no consideration for a cut.
And it certainly wasn't potentially a unanimous laissez-faire to hold either.
Oh, it was a unanimous decision to hold, but they're still obviously concerned about inflation pressures. We did get a new set of forecasts, so we got the statement on monetary policy, it comes out every quarter. So we get a new set of forecasts from the RBA. So they see unemployment maybe being a little bit higher than what it was, GDP growth They're saying it's going to come down from around 2.5 to 1.4 and then go back up to 1.8. So that's a little bit stronger than what they had previously. They see trimmed mean inflation getting back to the midpoint of their target range at the end of next year, so December 2027, 2.4 from 3.6, and they see wages coming down. So, yeah, it's still a fair way for them to get to their target. And I guess to the extent that they see that slipping, then they will be lifting rates.
There'll be action required. How's the market looking at that off the back of this week's meeting and I guess the press conference?
Yeah, so not too much change. I think we're looking at a 20% chance of a rate hike in September, so pretty low, and 50% roughly by December. So still some possibility of a rate hike, but not huge by the end of the year.
Yeah, certainly eased somewhat from where it was anyway.
Yeah.
And domestically, reporting season, leaning into that, what are you particularly looking for? You talked a little bit about the property market and other things there. When it came to the RBA, it's certainly very topical right now.
Yeah, so we've had Westpac and ANZ do their quarterly reports for the June quarter. These are, of course, companies that report on a September year end, but both of those, sort of fairly modest growth year on year. I think 1.8, 1.9 billion for both those companies, about 2% earnings growth, so nothing too exciting. CBA, obviously the big heavyweight that was keenly watched. They had a very good result. Well, what looked like a good result on paper, $11 billion profit, 7% growth, so certainly higher than their peers.
Raised their dividend.
I guess the thing was that, there wasn't a huge market reaction to any of those. Well, there was to Westpac, but it was more the commentary around, new loans and loan approval and credit growth. And they were all reporting pretty weak numbers over the last 3 months. So sort of fall of, 15 to 20%, depending on which bank you were talking about, 12, I think, at ANZ. So falls in mortgage volume, number of mortgages, particularly for investors, really on the back of the rate rises earlier in the year and the changes
and the potential tax rule changes.
Yeah.
I guess it's just real world evidence of some of the other data that we're hearing and empirical conversations around what we're seeing in the property market.
Yeah, so we had the Catality property figures for July, which showed capital city prices down 0.9%. So, led by Sydney and Melbourne, particularly for the more expensive suburbs, more expensive properties coming off quite a lot. So, a lot of people are now saying, I think ANZ had a forecast of 10% decline in property prices. So it's sort of feeding on itself.
Yeah, it's certainly catching plenty of media attention and probably any prospective buyers or sellers' attention right now.
Yeah, I mean, interesting. CBA's Matt Common said, he thought it was healthy actually, because we need to kind of rejig the economy away from just buying and selling properties to each other, and try and free up investment for other more productive activities.
No, certainly plenty of debates around that, and I guess the big intergenerational wealth question that's linked to that one as well. Excellent run through as always, Nick. Very much appreciated. Thank you to you, and thank you to all our listeners.